G'day and welcome to this week's video. This week we're going to have a look at obviously valuations of markets, and this is something that we've been very well aware of, particularly since in my advising times we've been through the tech wreck, and then we've been through the GFC, and there are times when the markets become overvalued and people become very greedy and they have this fear of missing out, so they're piling into the market and essentially paying too much for assets well above what they're actually worth. So as I've been through those two very tough times in investing, the last 20 years of investing, and there will be more crashes and corrections ahead of us. There's no doubt about that we will see them. We just don't know when and how severe they're going to be or what will cause them. So we get watch and pay for a certain amount of research to make sure that we've got a bit of an understanding of where the markets are at from a fundamental point of view, in terms of how they're valued. So we're not blind to this, and one guy that we've used extensively over the last probably since the GFC is Tim Farrelly, an economist based out of Sydney, and he provides the tipping point tables, which you can see here. And the one area that really stands out as overvalued, based on Tim's analysis, and that is looking at earnings growth. He's also looking at the dividends and also the PE ratio, so the price to earnings ratio, which is essentially a measure on how optimistic or pessimistic a market is. And when I say a market, I'm talking about the participants, the investors. You can see here the S&P 500, which is the US index, is well into the overpriced area here in the red. So what Tim's essentially saying that over the next 10 years, he believes the forecast return for that time will be a bit under 3%. Now, the reason why he does a 10-year forecast is because over a short term, none of us have any idea what the market is going to do over such a short time frame, and he believes that obviously is well overpriced. And because you're only 0.25% above a term deposit, which is our risk-free rate of return, this is where we've been pulling back out of some of the global assets. One other area we've been watching very carefully, that is Professor Robert Shiller's the CAPE ratio, and this is having a look at the US market back to 1880s and prior. That we can see here that it has an average of close to around 16 times. It's a price to earnings ratio. That at the moment we can see here that we're over 31, so nearly 100% over the average. And you can see here this was the tech wreck, and this was Black Tuesday. That is 87 in here. But so Professor Schiller is a professor at Yale University, and he's won a Nobel Prize for his work in economics. But what you can do is obviously check out these, his ratios, and you can check on Barclays' website. So they have the historic CAPE ratio, and so if you do a search of Barclays Schiller CAPE ratio, this should come up. So here you can see slightly more updated that it's 31.7, so nearly 100% above the average. And we can see, there's the tech wreck, and this is moving into the GFC here. So even at the depths of the GFC, obviously tremendous value there. So definitely one to watch. But what we can do there is add in many other countries, so we can see the valuation differences between all these different types of countries and markets. We can throw in Hong Kong. Obviously Hong Kong has come down pretty strongly in recent times. Not surprising that Canada there is very, very similar to Australia, given they're both heavily reliant on resources. So go and check out Professor Schiller's work through the Barclays website, and you can go and have a look at the the different countries and have a look at how they're placed from a valuation point of view. But at this stage, for me, caution is particularly for global assets is probably what we're taking, and sitting on cash and waiting for opportunities is been well advised. So thank you for listening. Please subscribe to the channel if you like. That'd be great, and we'll see you next week.